Welcome to the Trading Underground Show. In episode 4 of our A to Z of trading terms, we will look at portfolios. What is a portfolio? In simple terms, a portfolio is a collection of investments. So let's say you have a £100,000 portfolio, £33,000 of that is in your own business, £33,000 of that is in your own home or another home that you've bought, and £33,000 of that is in capital cash. That means a third of your portfolio is in business shares, a third of your portfolio is home equities, and another third of your portfolio is capital cash. So in simple terms, as I say, a portfolio is a collection of investments. Every person or family should model out their own portfolio. Homeowners, business owners, to investors. There are two types of main portfolios that are out there. An investment stroke trading portfolio and a personal stroke family portfolio. Personally, I use both, and a lot of people do. Now let's look at a portfolio allocation model, and we will start with a £100,000 example portfolio. And this is TU Markets portfolio allocation model. This is what we use as part of our allocation model that we adapt to our portfolio. There's a £100,000 example. £40,000 of that is in capital cash. 10% of that portfolio is in long-term stocks and equities. 40% of that portfolio is trading capital, and 10% of our portfolio is commodities, mainly gold and silver. So 40% of our portfolio is cash, 10% long-term stocks, 40% trading capital, 10% commodities, mainly gold and silver. We can add bonds to our portfolio, government bonds, corporate bonds. There are various bonds out there on the markets, but we choose not to. Bonds are usually very strong instruments, but at the moment they're not paying much, and personally I don't believe they're that strong at the moment, and TU Markets, we do not think they're that strong at the moment, especially government bonds and corporate bonds. So there's an example portfolio allocation model. £100,000 example, £40,000, 40% of that portfolio is in cash. £10,000, 10% of that portfolio is in long-term stocks and equities. £40,000, 40% of that portfolio is in trading capital. And 10% of that portfolio, £10,000, is in commodities, mainly gold and silver. So a portfolio allocation model is usually based around a percentage that is derived from the amount of money in each different investment. There are 6 main fundamentals behind a portfolio. The first one is to build up a portfolio over a short-term process. Don't go in on investment instantly when you start a portfolio. The second main fundamental is diversification. A diverse portfolio is a strong portfolio because you're not putting all your eggs in one basket. And if you have commodities like precious metals in your portfolio and stocks, then commodities and the precious metals will rise in price if stocks were to go down in price, and vice versa. So diversification partially allows an investor or a person to hedge their portfolio. Third fundamental is you must have liquid capital. Here at TU Markets, we like a strong liquid capital position, and we use 40% of our portfolio as liquid capital, and we use a small part of this liquid capital that is held in cryptocurrencies. TU Markets believes that a portfolio should have at least 15% of that portfolio in liquid capital cash. We go by 40%. The fifth main fundamental is leverage ratio. A strong leverage ratio is 2 to 1. TU markets, we don't go no higher than 4 to 1. A leverage ratio is basically how much you lend to invest into areas. So if you've got £100,000 portfolio and you put £20,000 on that portfolio down on a home and lend £100,000 to buy that home from a bank, that means your portfolio is worth £200,000, but you owe at £100,000, which is a 2 to 1 leverage ratio. The sixth main fundamental for a portfolio is always compound it and do not use a portfolio as a regular income. Compounding in the markets and compounding investments is a very, very good long-term strategy. Here at TU Markets, because we are basically a business fund, not a personal fund, we take 20% of all our profits from our portfolio out each year. So whatever performance we make on our own portfolio, we will take 20% of that profits and give it back to ourselves as traders, and we will leave the other 80% of profits for the next year investment / trading. So the 6 main fundamentals: build up the portfolio over a short-term period, diversification, always hold liquid cash, have a stable weighted allocation, have a strong leverage ratio, and compound your profits over a long-term stage, and do not use your portfolio as a regular income. So these are all simplistic terms for portfolio and a portfolio allocation model. Now, thanks for listening, and feel free to check out our website and our private community. And until our next show, have a prosperous and a profitable time. And do remember, lovers love, builders build, and us traders, we trade. Goodbye.